And we are live. Hello, everybody, and welcome back. Today, I'm joined by Juan Lopez from VanEck Ventures, and we're going to get into all things digital assets, stable coins, VCs in Web3, and VanEck's investment thesis for where Web3 and digital assets are going in the next few months and years. Juan, thank you so much for joining us today. How are you doing today?
Doing good, Anthony. Thanks so much for having us.
Awesome. Appreciate you joining the show. As always, this is a LinkedIn Live. So if you're watching if you're joining us, give us your GMs. Let us know where you are, what you're working on, what your experience is in Web3. And if you've got questions for Juan or for myself, please do put them in the comments. We'll try and get to them as we go through the show. Or if we don't get time for it, we'll try and come back to them in the comment section after. So please do let us know where you are, what your questions are, what you're working on. And let's get into it. Juan, let's get started. For those people who don't know you, could you give us your brief introduction and how you found yourself working in Web3?
Of course. Thanks, Anthony. So I'm a general partner at VanEck Ventures. We're the venture fund sitting within the broader asset management umbrella of VanEck. Happy to go into VanEck and sort of what else we're up to. But I got into crypto like many of us in 2017. Started to dig into stablecoins and sort of the Ethereum blockchain. My first gig out of college was at IBM. I worked in the corporate treasury. And I had a particular role around sort of overseeing what automation and analytics we could apply on the sort of front end of things, and very quickly found that my passion was in how do we sort of abstract the whole back end and rebuild from first principles. And I got pretty excited about that topic. Spent a couple of years there. I got the opportunity to leave and join Circle and hop around a few roles. I spent some time in BD and product management, and ultimately landed in Circle Ventures. There's a funny story there, which I got to DM Jeremy Allaire with some ideas around where we should invest our corporate assets. And a couple of months later, found myself founding Circle Ventures with my partner, Wyatt Lonergan, who we're both now at VanEck Ventures. So spent some time there. And it turns out that at the very same time as we were thinking about next steps, VanEck was thinking about launching a venture fund. So happy to unpack that story a bit further. But we ended up joining about a year ago and raised a $40 million vehicle tailored towards early stage. And yeah, super excited to be here.
Wow, not a bad introduction. Thank you for that. So IBM to Circle to VanEck, and what it feels like a very accelerated path. So congrats to you for getting to where you are, and for getting out of IBM. As a fellow IBMer also, it's a great place to learn. It's a great place to be entrepreneurial. It's a great place to understand the fundamentals of business and how to actually implement technology. But finding yourself closer to the permissionless world is not a bad thing either. So congrats on the breakout. I think we will do the unpack of VanEck for those people who are listening in. Not everybody has a deep fintech background, or not everybody here has worked in investment management and so on. So for those people who don't know VanEck, give us the short version. What does VanEck do, and where does VanEck Ventures sit in the overall hierarchy?
Of course. Yeah, so VanEck is an asset management firm. So what we do is we make it easy for investors to access assets that perhaps were hard to, maybe they have high limits, or maybe they're in emerging markets, and we make it easy for investors to go into the Robinhood account and invest. The firm was started in 1955 by John VanEck. It's always been family owned ever since. And we've been predominantly known for being the first to bring a gold-based mutual fund to market. This was in the late 60s, and then we were one of the first to bring a large gold miner ETF to market. It's called GDX. Today, VanEck manages north of 100 billion in assets under management, predominantly in mutual funds and ETFs, like I said, and we've been a leader in providing access to assets that perhaps are difficult for investors. Originally, it was gold, commodities, emerging markets, but now it's actually been crypto, which has been a relatively small share of our business, but growing, and there's a lot of interest. In crypto, we have a relatively small team, roughly about 25 people that either directly or indirectly touch our strategies. We think of these as like both public and private strategies. On the public side, we have ETFs, which you can, like I mentioned, you can go to HODL, you can go to Schwab or Robinhood and invest in HODL, or our Bitcoin ETF. But going over to the private side, that's where we have more sophisticated strategies for perhaps private investors to invest in a hedge fund. We have a liquid strategy that's managed by Pranav Kanade at VanEck. And now we have our venture fund, which sits a little bit more further out in the risk spectrum for private investors that want to invest in or want exposure to startups more broadly. And And yeah, that's generally what we do. And we sort of, the inception of VanEck Ventures and where it sits is there was demand from both investors and founders to have us in this particular stage in the cap table. So for a founder, you can work with VanEck at a very early stage through a fund, but quote unquote sort of graduate and work with perhaps our liquid fund or perhaps our public funds and ETF side.
So very much the intent there is to be able to have your investors exposed or have access to Web3, early stage Web3 startups, maybe more mature Web3 startups, all the way through that life cycle, right? From, Bitcoin is probably the most mature blockchain products. It's the most mature thing you can buy in Web3 at this point in time. Dial it back, you've got probably infrastructure providers or layer 1, layer 2 blockchains that are, multi-billion-dollar market caps, but maybe investors don't want to go and invest themselves, don't want to be self-directed, would rather have a portfolio approach with an investment manager. And then also and we'll get into that in a minute, will be specifically investing in unique projects that you see disproportionate value. Is that is that about right?
No, I think you said it better than me. So that's generally what an asset manager does, right? Like we'll have dedicated strategies across each of these sectors with different risk profiles, right? So you'll find that investors, depending on their mandate, whether it be ultimately retail or whether it be a pension fund, right? They have different mandates, different ways they want to express that view. And particularly in digital assets, which is still very much like a fractional share of their overall interest, I think where we're going is we want to have a full suite of products where we have something like a Bitcoin ETF, as well as something that's much more sophisticated, like a venture fund.
Got it. And again, when you're looking at ventures, right, just because an organization is using blockchain technology, you may actually just look at it as a fintech. Or you might say, actually, this is a company that uses blockchain and AI. Does that mean I'm only allowed to be in a blockchain fund or only allowed to be in an AI fund? Let's jump into that now, actually. While we're here, while we're at the top of the show, I'm really interested in the VanEck investment thesis or the VanEck Ventures investment thesis. I think you're looking at tickets of somewhere between 500K and $1 million for the investments you're making. From what I read in the press release, you're looking at something in the order of 30 to 40 investments in total. Curious to know, has that thesis changed since the press release, which I think was maybe 6 months ago? Have the number of projects you're looking at, has the target changed? Where are you in the cycle at the moment?
No, great question. So the thesis hasn't changed, and we hopefully don't expect it to change. But yeah, we're a $40 million early stage vehicle. We will be making roughly about 30 investments over the next couple of years. We've already made a number of them, which we're happy to go into, and generally with $1 million check sizes. So that's kind of where we sit in the space. The thesis, which is interesting, and happy to share more about sort of the inception story, was threefold. There's kind of three major points that I'd make there. One is that it's clear to us that value accrual wasn't just going to happen at the layer 1 level, and that you were going to start to see progressive value start to accrue at the application layer. It's sort of what we're seeing today across various on-chain ecosystems, specifically in Solana. Two, I think generally as we start to become more active on the crypto side through some of our other products, like I mentioned earlier, we started to see high demand from both investors as well as founders to have VanEck at this particular stage of a company lifecycle, right? Whereas perhaps with a project like Avalanche or Arbitrum or Optimism, which are much more mature and they have different capital requirements, or they're at a different stage of their journey, we had projects with very talented founders that wanted VanEck involved as early as possible. So there was both demand from projects as well as investors. And then lastly, we sort of realized that there was synergies between our current products and our current portfolio managers, as well as VanEck more broadly, to have broader exposure into this sort of capital market that's pretty unique in venture. So all those three things lined up at the same time as my partner Wyatt and I were exploring next steps while we were at Circle, and things sort of lined up perfectly. So going and sort of double clicking on our thesis, and this is sort of something we observed at the time, is we saw stablecoins and blockchains generally sort of collapsing the supply chain of both payments as well as capital formation, what it means to make payment from point A to point B, as well as to issue an asset and raise capital for that asset. It's just generally what we observe is sort of the big disruption here. And our thesis is to invest in some of the best founders that are coming into the space now to build applications that are going to capture value in that. So happy to go into some examples, but that's what we're most excited about.
Definitely. I'd love to go into some examples, but just to kind of maybe draw the thread around. So are you also looking at projects where there are synergies to some of the other investments VanEck's making, or to products or services that specifically disrupt investment management, or some of the that are synergistic with some of the other investments you're making? Or do you see Web3 as a kind of an isolated new business model challenge that may not be able to work its way back?
No, I think that's a great question. So the short answer is yes. Like I mentioned, sort of capital formation is this sort of broad construct that we really see get disrupted through tokens and blockchains. And I think there's a big sort of question in VanEck about, what does the asset management firm in the era of blockchains really look like? And how do you productize that? How do you start to learn today? And how do you start to sort of align yourself with an ecosystem such that you're one of the preferred partners at a time where this really actually starts to become mainstream? So I think most of our investments today probably don't have sort of a strong synergy with VanEck. Again, we are a private fund with mostly outside capital, so we can only play the strategic lens when it really, really makes sense for our LPs. But there are 2 or 3 investments where we actually do view strong synergies where VanEck could actually partner with this company and meaningfully accelerate their vision. And I think that's what LPs, some of our investors, saw as one of the value adds in being a part of our fund.
I find that really interesting because in some cases, some funds are literally just allocating capital, looking for returns and so on, and that's fine. There's a place for that model. And as you said at the beginning, the total amount of assets under management with VanEck Ventures versus the total VanEck business is still relatively small, but the potential for disruption is high, or the potential to rewire the traditional model of investing in capital management. Back when I was working at Deloitte in 2017, we were talking about asset servicing transformation, looking at shared KYC utilities, fairly mundane stuff, right? Not as sexy or not even as groundbreaking and significant as stablecoins at the time. We were really just looking at business model efficiencies. And even in those places, an application that makes use of decentralized technology can have value. What we're seeing here is actually digital assets as investment classes, stablecoins as alternative rails for payments, and so on and so forth. It is a much, much, much bigger market. And the opportunities there are significant. But because VanEck is positioned the way it is, because of the number of assets it has, because of the number of markets it's exposed to, you have really good, I guess, native understanding of how those industries work today, how those processes work today, and where the opportunity for disruption is. And so for any founder working with you guys, that's phenomenal access. I wrote a post the other day, it was somewhat tongue-in-cheek, about how Web3 founders go out to the market and talk about how blockchain is going to transform things without actually understanding how things work in the traditional industry. And that's a problem, right? Because if you come up with a decentralized view of the world and say, well, Web3 could change this, but you haven't spent 10 years working in traditional finance, or you haven't spent 10 years working in investment management, it's really hard to pinpoint the exact point in the process. And people use generalities. And then very quickly you realize that they're talking in theoreticals as opposed to an actual understanding of a business problem that they are looking to specifically address.
Yeah.
And so then I guess in that story, it's like a long story, having VanEck in your corner is not a bad thing.
No, it's an amazing thing. And just to give you sort of a couple specific examples of how we're winning deals and why founders are choosing to partner with us that sort of address this is, first, we provide multiple vehicles of capital where we can not just invest at an early stage, but perhaps our liquid fund could invest once there's a token that's liquid, or a company that's gone public, or participate in private placements and so forth. And there's even been cases where some of our exchange traded products have listed many of the notable tokens in the market. So I think it's not too far-fetched to think that some of maybe perhaps one or a couple portfolio companies start working with us, eventually launch their token. Perhaps a liquid fund could participate. Perhaps there could be an exchange traded product, so the whole world can participate in a.
That's a really important one. I'm glad you mentioned that, because there's another model around capital raising and the founder experience that I've explored with a couple of other conversations, which is around centralized exchanges investing, or centralized exchanges having relationships with founders, because in that model you get access to capital, wallets, distribution channel for trading, potentially some marketing, potentially some strategic support, but in reality the exchanges, that's not really how they spend most of their time. But that fully integrated story for a founder is really compelling. In some cases, there are exchanges that are offering, shortcuts to getting staff, office space, and locations in the Middle East. Right? It goes down to that level of depth because that's where the relationships are, and that's the founder experience they want to create. I see that the story you've told there is kind of analogous to what the exchanges are offering, but in a more TradFi and I guess much bigger kind of way.
Yeah. I mean, that the same could be said about us. Different points of the market, right, where an exchange is mostly looking to monetize in sort of volumes and the lifetime value of their existing retail users. For us, it's much more about assets under management, if I'm honest, and sort of having a diversity of product that perhaps doesn't exist in the market. But yeah, I think that's a great point. And maybe a couple others that I'd mention is, we're obviously noticing the disruption that's happening with some of the tokenized assets that are coming to the market. Still relatively small, sort of in the single-digit billions, but we want to partake in that as well, right? And in doing so, there's a number of challenges that come up, and I think a big part of our thesis is also how can we address those challenges and work with some of the best founders that can help us take some of our products to market, as well as capture some of that value and participate in some of that ourselves. So yeah, I think that's maybe a great example of that is sort of the Biddle BlackRock fund that's done in partnership with Circle. That's something that we're very interested in as well, and I think we'll have a lot more to share on that. But I think the broader narrative there is that we'd be looking to strongly partner with some of our portfolio companies to enable that, or at least we'll have the incentive to do so.
Fantastic. And again, that integration, the more you can back the Web3 capability and capital into traditional larger markets or larger infrastructure, the faster things move, the faster we get progress. And it's not just about enabling everybody to buy in Bitcoin, right? At this point, if you want to buy Bitcoin, there are literally billions of ways you can do it. And that's not changing the game. That's not transforming or rewiring industries yet. That's increasing the opportunity for people to buy into that particular asset class. But from what it sounds like, you guys are taking a much, much more deep and broad view, which is awesome. I want to get your take briefly on other Web3 VCs. VCs get a lot of shit from time to time. Apologies. I mean, this is a family show, but I think swearing's allowed. I'll bleep it later if not. It depends how Spotify feels about it. But VCs, generally speaking, get a lot of heat for either pumping and dumping, doing token-only investments, because that's where they see the value rather than the more strategic type of partnerships, and that in certain stages in the market, capital is harder to come by. Or that I have friends who are looking to raise themselves, and at this particular point in time, everybody thought we'd get the Trump pump and it was going to be, capital flowing everywhere for everybody all of the time. And the reality is very different. How do you see the kind of current VC landscape within Web3 or for Web3 founders, and how are you differentiating? What's the story to founders compared to what else is going on around us?
No, that's a great question. And something we talk a lot about internally. I think it's, to put the state of Web3 VC, I think we also have to talk about venture more broadly, right? And sort of what is the market structure for venture today, and why does so much capital end up falling in sort of concentrated vehicles that perhaps prevent some of the best companies from being accessible to retail, right? I think it's pretty sad to see that some of the best companies in AI today, whether it be Anthropic or OpenAI or such, are broadly inaccessible to retail. And I think that's sort of a symptom of the market structure you're seeing in venture, where companies both don't see the need or the value in going public, and a lot more capital is getting concentrated in vehicles that are starting to look a lot less like venture and much more like asset managers. So just like we're expanding into venture capital is also expanding into just broader asset management and having lots of vehicles where they can double down and provide unique returns to their investors. So there's this pretty interesting sort of incentive scheme and market structure today in venture broadly, where a lot of capital is concentrated at the sort of very early stages of the risk spectrum, and containing that in a way that's sort of kept for itself. And by the time OpenAI or Anthropic are available for retail investment, like these are going to be multi-$100 billion companies, right? So the upside is very, very capped. I think zooming out from that and now zooming into crypto and what's happening in Web3, you see somewhat of a similar market structure and perverse incentive, where in prior cycles, it became pretty clear that the sort of layer one narrative and the fact that tokens have a unique liquidity profile, right? Meaning that as opposed to a traditional venture investment, you can theoretically invest in an early stage project and have it be fully liquid in about 3 years, as opposed to perhaps the 10-year sort of market standard in traditional venture. It sort of introduces a little bit of a perverse incentive, we think. And that's driven a ton of capital to flow into the space from both traditional venture and sort of Web3 venture. And it's introduced this sort of short-termism, if you will, around, hey, there's this playbook of investing in a company that's going to launch a token. And then when the token launches, we're going to create a really big narrative such that there is, perhaps some exit liquidity and investors can hopefully capture some of that return. We think that it's unclear to me if that is over. It's clear to me that that is not good for the ecosystem.
I'll agree with you on both. I think it's certainly not over. I mean, if the mechanic exists, it'll never be over. But it certainly isn't fair, or it certainly doesn't represent an objective. And I guess we've got to be a little bit careful here too, right? Because we want markets to be open. We want them to be fluid. We want them to move fast. We want volatility up to a point, but we don't want to put investors at risk from malpractice. And so there's a really difficult line here. As I'm saying this out loud, I'm feeling the tension of, am I just asking for good investments only? And you're not allowed to go and play in Web3 if you're not good, or if it's not of value, or how do you objectively define objective? I think
what it boils down to, I think where it brings us to is ultimately a mispricing of risk for everyone involved.
Yep.
And what that means is, if you, as opposed to, maybe 4 or 5 years ago, when you could be sort of a quote unquote link marine, and you could be a big fan and sort of community member of that and participate, and perhaps you were rewarded for that upside, right? For the time and resources that you spent dedicating to that ecosystem, perhaps as a direct contributor, as an outsider, that just doesn't exist anymore. And I think that is going to shift the market structure towards aligning both communities and projects to find what is the right level of upside that perhaps the community should have for the level of risk that they're taking. And this is something we're pretty excited about. And we think this is we're at the very early innings of that, because I think the prior sort of market cycle or epoch is just starting to sort of realize that. And I think what's coming up next is we should have ways for both, and I'll address your question sort of, how do we feel about Web3 VC now? There's a lot of commentary around, hey, investors perhaps don't really add that much value, and they're able to extract so much out of this ecosystem. And while much of that is true, I think there will always be a role for a professional investor and a strong partner to come and work together with a company, perhaps in the really early stages, just as much as there is a role for the community, right? And I think a lot of the success that's going to be ascribed to some of the biggest projects in this ecosystem is because of the strong communities that they have and the strong user bases that they have. That again, at the end of the day, one of the biggest attributes that this industry has is the ability to just ascribe ownership to virtually anyone in a virtually very, very easy fashion. And those two things will come together in the next cycle, we think, where investors and communities will be able to work much closer together. We're really excited about crowdfunding for that reason. And we're really excited about the idea that both investors and retail should be able to invest at the same terms and not act against each other, if you will.
I really like that. That's a brilliant juxtaposition as well, and I want to go in on that just for a second because it's definitely triggered a few thoughts for me. The difference between just capital and strategic partnership, community driving promotion and adoption versus decentralized governance being able to or not enable an ecosystem to grow. Right? If you think about kind of traditional corporate growth paths, and this is a journey I've been on in my career, you don't necessarily go to the investor base to talk about, well, how are we going to enter the German market, or what's the best thing for treasury management strategy for the next 2 years. You need specialists, or you need to some extent qualified experience to be able to do those things. So when you think about how do you take a scrappy startup from really strong potential infrastructure to a team of 200 people that's actually humming and that's really making the most of decentralized technology, but is also operationally effective, that's not something you get from a decentralized community or a DAO necessarily, or at least today we haven't seen that. At the same time, the power of these decentralized networks is that you can airdrop to a community of 10 million people tomorrow, and you've immediately got an incentivized customer base, or an incentivized marketing team, or an incentivized development team, depending on how you want to do it. Not everyone out there is going to be vibe coding the protocol, but at the same time, that's an asset for you. I'm not sure that we'll see that many. I don't think it's as easy for a protocol team or a DApp to professionalize without external support. I think it's hard. You may get lucky and you may find founders who are on their second or third company or who've been through the run before, and so they get it. But I don't think it's either or. I think you need some degree of professionalization support along the way. And it feels like a VC or an investor can be that, providing it's not at the expense of the community. And I also want to double click on your point around crowdfunding, because what I think you're suggesting there is actually being able to, in the same way as retail banks 10 years ago or 15 years ago were looking at peer-to-peer lending as an extension of the loan book that they wouldn't offer against. Are you suggesting that at VanEck you're opening up the capital table for non-traditional LPs?
Unclear if that's something we would do for at the VanEck level. But we
or
are
rather
in
your space, how do you think about crowdfunding as you described it?
We think about it in the sense that the biggest problem with crowdfunding has been adverse selection. Like this idea that it's always not the best projects that end up in a platform where perhaps non-traditional investors, non-professional investors could come and participate. However, I think we can objectively argue that a world where OpenAI and sort of ChatGPT users, as well as professional investors, and those that are advocating for the distribution and perhaps even governance of the product, would perhaps end up in a potentially better outcome if everybody had skin in the game and if everybody priced risk accordingly, such that you have at least similar upside. And if you sort of double click on that and unpack what is the sort of crowdfunding platform of the next era look like, it's hopefully a place where you can have both professional underwriting of a project from a trusted source, right? That's something you can only rely on through reputation. So is there a model where investors with reputation could enable access to a community with reputation that is going to actively contribute or be of value to a given project? And this has nothing to do with crypto, right? I think at this point we're talking about a model where perhaps crypto is a tool to further vet for reputation and to allow this idea of sort of skin in the game and ownership. But I think the next model of crowdfunding probably blends some of those worlds together to sort of get around that problem, such that there's an actual incentive from the best companies in the world to come and enable access to their communities in a way that they don't have to deal with cap table management, or they don't have to deal with multiple, like nobody wants to go and have like a million conversations with different investors, right? They much rather deal with one. So could this be a trusted source, a trusted underwriter that enables access to the rest of the community to participate, all based on merit, all based on reputation? Could that be a better outcome for a given company? We think there's a strong thesis there.
Got it. That's really interesting, and I'm really excited to follow where you guys go with that one, because again, I think the ability to, from a VanEck perspective, it's not necessarily just that you want to access more capital. Access to capital probably isn't your challenge, but being able to create more effective investments. If you're able to bring in, I don't want to say the word vetted, but I think you used a better word, but to be able to bring in investors who can help the projects grow, maybe in a less active way, or where you can start generating a professionalized, organized, nascent community alongside an early stage investment, is a very, very different model to an airdrop, right? And I think it actually has a very different likelihood of success, or it has a very different success or growth path than an airdrop. And as somebody who spent not an insignificant amount of time over the last 2 years looking at different airdrop models, looking at different allocations, different regulations, and so on and so forth, the ability to issue 100% of your supply to the world and say, right, this is out for everybody, do with this as you will, is fascinating. It completely turns the investment model on its head, because you're saying, okay, we're going to put a whole bunch of tokens out there. Anything that people don't want, we're going to bring into the treasury. And assuming we do the marketing and the positioning correct, these tokens will have some sort of future value, or some sort of sense of future value. And so we can use that from a treasury from day one. And so, poof, zero VC launch. It's risky, right? And if it goes wrong, or if too many of the community take your tokens, there's nothing in the treasury, you've got a problem. If you don't get your forecasts on block production rewards right, no one's going to validate your blockchain. And again, there's so much math and science in getting the different parameters of this right or wrong. It's very, very hard. What you're describing, I think, is a nice halfway house between, VC will allocate capital and then they'll extract it when they need it, versus you're saying we can do better, we can do different, which is really interesting.
Yeah, no, I think we can do.
Sorry, go ahead.
I was going to say, I think we can do much better. And I think if any of us in the venture space are going to be around in 10 years, it's going to be because we figured out a way outside of this very market sort of extractive thesis of we're going to invest hundreds of millions of dollars into X project, and then we're going to liquidate once it comes out at multi-billion-dollar valuation, and then someone else is holding the bag. If we're around, it's because there's an actual sort of positive sum type outcome that ends up with hopefully multiple projects that are outstanding, regardless of how much they raised, regardless of who participated and when, that there is alignment and the right orchestration of incentives, hopefully as early as possible, such that there's an actual sort of strong community that gets built over time, and not just at the time where there's an airdrop.
I think it's a perfect time to start seeing a different engagement model between traditional investors or professionalized investors and communities. I don't think it has to be either or. And I think, honestly speaking, I think the adversarial relationship between communities and VCs is unhealthy for the industry broadly. I think healthy skepticism of investors' incentives should always be there, right? Is who's actually in this for the long term, or who's in this for what period of time? What does that mean for everybody else? But that doesn't have to be cloak and dagger. That can be clear. That can be phased. That can be promoted. That can be regulated. That's really interesting. I don't want to spend the entire show going down that avenue, but I'm really glad that you brought it up, because I'm excited to see somebody try and solve for that, as opposed to it being an either or. I don't want to be an either or person in any situation. Obviously, it makes it hard to make choices sometimes, or you don't have to, or don't make choices. Bring everything together. We did say we were going to get onto the state of digital assets. So we talked a little bit about Bitcoin at the beginning of the show. Obviously, that's the OG, the most well-known, probably most publicized, probably most held digital asset in all of Web3, but there's an awful lot more to it. Give us your take, Juan, on where are we in the maturity, attractiveness, and engagement with digital assets at this point in time?
Yeah, no, that's
Not
always an
necessarily in that
interesting
order.
one. That's always an interesting one, and I think zooming out and thinking about where we are, despite the current market conditions, with there's a lot of volatility, and I would say that that's largely macro driven. We've actually never had a better moment in history for crypto startups to build, in my opinion. Founders can now ship products that sort of leverage all the best things of crypto: instant settlement, global accessibility. You can eliminate sort of rent-seeking middlemen. A lot of the infrastructure that we've had in the back of our minds as a core challenge, whether it be scaling layer ones or abstracting the custody of some of these assets and sort of throwing away the concept of like, hey, how do you manage this like private key? Even though that's very important to many and will continue to be important, we're abstracting that for the mass scale user. And the reason why is, I think, this, and sort of one of the reasons why I would say is this current administration has actually implemented policies that are somewhat aimed at fostering this innovation and reducing like these like large regulatory barriers. So whether that be the crypto task force or the new SEC and CFTC chairs, or sort of broad scale deregulation that appears to be happening in the space, I think all of that ends up materializing in an influx of high quality and high integrity management teams and founders that are now starting to look at the space and thinking about what is the sort of long-term view. And perhaps many of them read the Bitcoin white paper or saw Ethereum come about, and they were idealistically aligned with the industry and they were excited, but they weren't quitting their jobs, right? Like they weren't giving up their end of year bonuses or the equity in the prior startups that they were in. Now we're actually seeing a turning of the tide for that next batch of founders that's coming into the space, and I think that's very promising. So that's the first thing that I would address, is just the quality of people that are entering into the space is extremely promising, and I'm just echoing what we're hearing from the market there.
And as somebody who takes 50, 60 meetings a week of potential founders looking to work with VanEck Ventures, you're probably see more of that than almost anybody in any quarter, right? You can go to a bunch of meetups and meet whoever tends to be there on the day, but your job, it literally is to filter through the quality of projects and the quality of founders together. So that's a helpful signal from a very well qualified source.
No, I appreciate that, and yeah, so we've been pretty excited about, and we've been progressively excited about this, right? Like I probably could have given you some semblance of this answer over the last 6, 12, 18 months, but we're increasingly seeing, I think the point being, we're increasingly seeing the quality of management and founders coming to the space increase and just raise the bar. We find ourselves constantly sort of re-rating the bar of a founder that we want to back. And that's just incredibly exciting, right? Another sort of major point that I would add, and maybe specifically double clicking on stablecoins, is it seems we're going to get regulation for stablecoins this year. And that's extremely exciting for both financial institutions as well as sort of non-bank actors to be able to issue this new form of money that's a little bit more abstracted, it's much more general purpose. And based on what we're seeing from the Circles of the world and from the Tethers of the world, seems like there's a really strong thesis for, who is there a world where you can own the whole vertical stack from issuance to payment acquisition and monetize that all through net interest margin. So that's getting a little bit into the weeds, just looking at Circles S1 and some of their intentions with the payment network that they just announced yesterday. But all that points to, we're just entering this utility value phase for crypto, where whether you're a fintech founder, whether you're an AI founder, you're starting to see that the right level of abstraction and ecosystem development is here for you to go and build something that could be materially superior to a world in which maybe you build the same thing in traditional rails.
Yeah, the old model was, if you wanted to operate in financial services, the fast way is go and buy a bank somewhere. Right, go and buy a bank somewhere that already has existing infrastructure and existing license, registration, and maybe maybe some assets already that you can start moving around with. That's okay. That's fine as a model, but it's expensive and it's complicated and depends on, at any one time, how many banks you want to buy. And then you're also dependent on which the corresponding banks in which jurisdictions and so on and so forth. Obviously, the stablecoin landscape today, it's a select basket of some of the major currencies. But in other shows that we've done on this podcast, we're starting to see different smaller nations. I should never say small nations, but smaller nations than the United States start to have their own stable coins. And so you end up with regional specific stable coins, digital assets from those particular jurisdictions that can interact in real time, 24/7 on a blockchain in an automated way. And that starts to be the competitive alternative financial system that I think you're alluding towards.
Yep.
And that's now. That's right now.
Yeah, awesome. 100%. I mean, you can start a consumer fintech application today, and these are some of the highest growing startups we've seen in the last couple of years, right? The Felix Pagos and Dollar Apps of the world, where they really market themselves as consumer fintech. They don't talk about crypto whatsoever. But the unique advantage that they have relative to some of their competitors is that they can just integrate a stablecoin, and they completely they don't have to sort of act on this notion that they eventually have to become a bank or have to acquire a bank in order to distribute these kinds of services. So that is extremely compelling, and we think that's the entry point to the rest of crypto, right? Where perhaps you start with a stablecoin, very simple, like dollar savings or remittance product. But tomorrow you can lend against that. Perhaps you can sort of offer different types of DeFi vault into your protocol. You can offer something akin to what Coinbase is doing so with Morpho. That starts to really paint the narrative of these sort of projects that we've been working over the last couple of years actually reaching mass scale consumer.
Love that. We've got a question in here from Alize, and I think it's adjacent to a question I was going to ask, so I'll bring them both together. Ethereum came out with the tokenize everything as its mantra, and there are so many different asset classes around the world. In my career, even since 2016, 17, there were cold approaches from people in different parts of the world saying, hey, I've got access to a gold mine and I want to tokenize it. Can you help me? Right. And you can see this proliferation of, let's call it real world assets or physical assets or traditional assets that can be tokenized. How are you looking at that at the moment? Because that feels to me a parallel to the original VanEck story, right? Which is enabling access for investors to gold that was difficult at the time. But today that's not difficult, right? The ability to invest in gold, palladium, silver, nickel, whatever it is that you want to invest in, there's an index or a market for that that's pretty easy to get hold of. But everyone's screaming real world assets, real world assets, real world assets. Can you put some manners on where you think there is potential and there is need for tokenization, and maybe some other places where you can use the technology, but it doesn't really make the boat go faster?
Yeah, no, I think that's a great question. So the way we think about this particular category, which we're very excited about, is either one, it unlocks distribution and access to an asset that was previously either liquid or inaccessible to a particular user. So perhaps the best example of that is an investment in a company that we made in a company called Manifest. What they're doing is tokenizing home equity investments, and this is a particular asset where there's around, like, the minimums are 250K to invest in sort of a securitized basket of home equity investments that sort of have your home equity as collateral in case you were looking to borrow against that. And an investment bank or hedge fund might be able to tap into that, but it just doesn't make a lot of sense for this to be offered to retail, just given the back office costs as well as regulation. Like the existing securities law made that somewhat difficult. And what we're really excited about is there's many of these products, as well as many other types of strategies and funds that are where it makes all the sense in the world for an investment bank to put that product together to offer that to a sophisticated investor, but it doesn't make sense for them to securitize and register that to offer it to a retail investor, perhaps just in the US. And what we think tokenization unlocks for this particular sort of use case is you can tap into global distribution on day one. So perhaps your business case on what if you do all this back office work, who are you going to sell this to, becomes a little bit easier to make. That's one. And two, you can actually compose products on top of this, right? So what's really important to us in this sort of next wave of what we think of as real world assets is not just that you have the same user experience where you have to sort of go and KYC and fill out like different sort of registration docs to ultimately have to sort of download MetaMask and buy this asset. What we're really excited about is, how do you then take like a qualified purchaser model that can then sell this to a protocol like Athena or something of the like, a little bit more of a decentralized type approach that has a thesis to collateralize their product with this in order to offer something more sophisticated on top. So I think Athena is maybe the clearest example of that with the work that they're doing with Securitize and the BlackRock fund. But I think it's just the beginning. And that will be just one of the entry points for how retail users around the world will be able to tap into like these like very sophisticated strategies. And then the other way that we sort of think about it is perhaps there's assets that have not yet been securitized that are a little bit more esoteric in nature, that the notion of a token actually lets you sort of construct net new assets. And maybe the best example of that, I think, is what we're seeing perhaps in Helium or in Dawn, in sort of this deepened category, where if you were an investor, you said, hey, I want the most asymmetric, the asset that's most asymmetrically tied to internet consumption, hypothetically. Or you could say data storage, you could say compute, you could throw out like any sort of virtual commodity in this sense. You could go and as a private equity fund or as a public markets investor, you can go and sort of hunt like, hey, where can I get that exposure? But it's never going to be 100% clean. And you're always going to have some level of overhead or some level of like other exposure that you're not interested in. Maybe the best example of this for the stablecoin world is like, if you really want clean access to stablecoins, you're gonna you can invest in Circle, but Circle, you look at the S1, there's a bunch of other things that are also tied to that. And I think tokenization just gives you this vehicle or this mechanism for some of these emerging projects to actually tokenize a commodity, if you will, that doesn't have as much of the overhead in a world where perhaps it just wasn't possible before. So it's kind of a net new concept. It's something that we're really excited about, but we sort of view this two sort of sides of the world in tokenization. One where you can distribute existing assets that perhaps had certain requirements or were somewhat funky for the average individual to invest in. Maybe that wasn't a business case. Or two, there's these net new assets, things that weren't securitized, things that weren't productized in the past because there was an incentive, there was a mechanism, and now it's possible, right? So our view with Dawn or with Helium is that investors will eventually look at that and say, hey, these are some of the assets that are most asymmetrically tied to either bandwidth or data consumption. And, I don't have to deal as much of the bandwidth, as much of the overhead that comes with those assets.
Brilliant. Very comprehensive and well illustrated answer. And thank you for that, because honestly, it's very easy for people to say real world assets and sound like they know what they're talking about, or at least convince themselves that they think they know what that means. But what you've illustrated there, I think, is the traditional business model for real world assets doesn't necessarily need tokenization for the most part, or there are some asset classes that clearly don't. That having been said, if you are sitting on a gold mine and you do want to tokenize a whole bunch of gold, that's not to say there isn't some utility in being able to issue those tokens to stablecoin issuers to have as part of their backing. And that creates some degree of reduction in friction, such that value can be tokenized and leveraged elsewhere.
Yeah.
So
100%.
Not for all you gold mine owners out there, don't stop DMing me. You are still welcome to reach out. I will pass you straight on to Juan.
I appreciate that.
But it's not game over yet for tokenizing established assets.
Yeah, I forgot to mention one thing, right? Like you opened up with, a vision for Ethereum being tokenize everything. While these are some of the ways that we think about sort of what is like the real commercial viability that's materially better than, the way that we're structuring these assets and enabling capital to flow in the traditional markets. It's unclear to us in a world where like, you can tokenize everything, that's even sort of feasible from a market structure perspective. But the main problem being like we see like really strong analogies to this in sort of the on-chain markets, right? Where like there's fragmented liquidity of the same assets across many chains, right? And that creates like a really difficult market structure problem. And that's virtually the same thing that we're seeing across the board with most of the tokenized assets that are coming into spaces. They're simply just fragmenting liquidity between like the on-chain capital market as well as the traditional market where those assets are sort of natively issued and traded in. So you know, that's one interesting lens for which to think about it is why will fragmenting the liquidity for this asset make sense in the first place?
Very good. You don't have to have a degree in or a master's in financial services and have worked on Wall Street for 5 years or 10 years to be able to engage with this, to be able to be involved, to be excited about it. I want to ask you one last question before we close the show, which is what for you are the one or two things that you'd like to see happen in the next 12 months to see wider adoption of Web3 technology, not just in investment management, but more widely in some of the portfolio companies you're investing in? What do you think are some of the unlocks that you'd like to see to help us go wider and bigger?
Yeah, I think that's a great question. I'll give you two answers. One of them is it's going to take much longer than 12 months, to be honest, but we need to live it and breathe it today. And that is that this is the most important one. We need to up level our reputation. So the crypto and sort of Web3 ecosystem, I would say, has largely tainted its reputation, deservingly so, because of the events that have happened over the last years. And I think that requires some level of like market-based regulation where we like keep ourselves up to a higher standard with being transparent, having high integrity, having high conviction, playing long-term games, and sort of getting rid of these like short-term narratives and sort of get rich quick type schemes. That's the only way that we're going to attract more talent and more capital that's going to support this ecosystem to keep advancing, right? And I think that's one of the biggest things holding us back is this notion that if there's a really exciting new application that I want, one of my friends to try, the fact that I send it to them is like, hey, it's crypto, like I don't want to touch that. And it's going to take long, but this is something we need to sort of embody. Everyone in the industry sort of needs to up level our standards and have higher integrity, I think. And then the second piece is a bit more practical, which is like we were talking about before we started the show. I think the cycle is when we start to test the waters of what it means to compete for users and traction outside of this like crypto echo chamber, right? Like
outside the 100,000 angry degens on X.
Exactly. Like this is where we're gonna be, side by side with consumer fintech, right? And companies that have been around for years and have really competent management teams and they don't want to lose their business to some newcomer that's building stuff in crypto just because it's crypto. I think we start to test that this cycle, and what we tell our portfolio companies is you should treat yourself like you are in traditional tech, like a traditional consumer fintech company, fighting for the same user, talking to them in hopefully language that the same user will understand and should be able to meaningfully tell the difference of why this is better without talking about crypto whatsoever. So we need better abstractions, we need better product marketing, we need better comms, we need better user experiences across the board because, frankly, up to now, it's been unclear how sort of downloading a MetaMask wallet and saving that in your private key to then sort of getting rugged on one of these protocols is better than downloading an app and just connecting a bank, right? So I think we need to sort of keep ourselves up to both a higher standard on both reputation and having high integrity within ourselves, as well as higher standard of the user experiences that we think are actually going to onboard this next sort of mass influx into crypto.
So there you have it. Juan, a fascinating conversation, really interesting examples, really excited to hear the VanEck story, and very grateful that you're one of the ones championing higher integrity, better projects, better leadership, better management, and a more competitive industry. Thank you everyone for listening in. Thank you for your questions. We're going to get to those in the comment section afterwards. Appreciate you joining us today, Juan. Good luck. Keep us posted on what's coming next and stay safe out there.
Thank you. Thank you for having me.